Welcome back to the deep dive. Today, we are staring at a number that feels, well, honestly, it feels almost impossible. It's Friday, January 16th, 2026. The S&P 500 is trading near 7,000.
It is a staggering number, a nice round number, but yeah, staggering.
It really is. On the surface, if you just glance at the headlines, it looks like this unstoppable bull market, right? Everyone's high-fiving, retirement accounts look fantastic in dollar terms.
The party seems like it's going to run forever.
Exactly.
Right.
But if you start to peel back the layers, and that is exactly what we are going to do today, you have to ask a very uncomfortable question. Is any of this real growth, or is it just a trick of the light?
That is the question of the decade, isn't it? We're looking at a phenomenon we're calling the Great Divergence.
The Great Divergence. I like that.
Yeah, you have a stock market hitting these all-time highs, screaming everything is amazing, while the real economy, the one where people buy groceries and pay rent, it feels completely different.
It feels tight, strained.
Yeah, exactly. And we're not just going off vibes here. We have a serious stack of sources today. We're pulling from a huge market valuation analysis report from just this month, January 2026.
And this thing breaks down the Buffett indicator in a way that is, honestly, a bit alarming.
Alarming is one word for it. I'd say it's flashing bright red.
And we're pairing that with the latest commentary from investor Steve Eisman. You know, the guy from The Big Short.
He just dropped his analysis on bank earnings and what he's seeing for this very week.
So our mission today is pretty simple, but it's heavy. We want to explain why your dollars might be deceiving you. We're going to look at why Warren Buffett's favorite indicator is higher than it has ever been, and what a K-shaped economy actually means for your portfolio.
And maybe why gold might be the only honest truth teller left in the room.
Okay, but before we get into the scary math, and trust me, the math is a little scary, if you want to keep an eye on these temperature checks yourself without having to crunch the numbers by hand.
Right, because in a market this volatile, you really don't want to be flying blind.
We have a tool for that. It's a great way to stay on top of this stuff.
Yeah, you get the daily readings, which is crucial right now.
To track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
You da muffle store, Buffett, to
Yeah.
roll robet, yeah.
Dax Euro, Apple Store Abalaka Is Atishi. Meshiatsudijayan Arifa the Buzi. And the Bigichivan Onkaiche.
And of course, the legal stuff first.
Always. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice.
Conduct your own due diligence before making investment decisions. Okay, let's unpack this. We keep hearing stocks are expensive, but expensive is a subjective word, right?
Right. Warren Buffett has a favorite metric for this. He wants to know if the market is objectively expensive.
And that's the total market cap to GDP. Exactly. It's basically the price tag of all public companies in America versus the actual economic output of the country. Think of it like a price-to-sales ratio for the entire U.S.
So where are we at right now?
We're in completely uncharted territory. As of January 14th, 2026, the Buffett indicator is sitting at 223.6%.
223%. That sounds high, but I think we need context. Like, what was the dot-com bubble? Because that's the famous speculative mania of our lifetimes.
The dot-com peak in 2000, when people were buying pets.com for billions, was around 159%.
Whoa. Wait, so we are significantly higher than the dot-com peak.
We are so much higher. And if you look at the housing bubble peak in 2007, right before everything fell apart, that was only about 110%.
And the long-term average?
Right.
From a level.
The historical mean is somewhere between 90% and 100%. So at 223%, we are more than 2.2 standard deviations above the trend.
For those who skip stats class, 2.2 standard deviations basically means this almost never happens.
Exactly. It's a massive statistical outlier. We are stretched like a rubber band that is about to snap.
So if history is any guide, what does a number that high imply for the future? Because usually when you overpay for something, your future returns are, well, they're garbage.
That's the rule of gravity here.
Yeah.
Historically, when this indicator goes above 200%, it implies annualized real returns of -3% to 0% for the next decade.
Negative returns for a decade.
Yes. The data is basically predicting a lost decade for passive investors. If you just buy the index and hold on, you might make zero money in real purchasing power terms for 10 years.
You might actually lose purchasing power.
You might. It's a real splash of cold water.
Wow. And it's not just Buffett's metric, is it? There's another alarm bell ringing.
That's right. We have to look at the Shiller-Cape ratio. It's the cyclically adjusted price to earnings. It just smooths out earnings over 10 years so you don't get fooled by one good or bad year.
And where is that sitting?
It's hovering around 40x. Now, for perspective, the only other time it broke 40 was late 1999, right at the peak of the dot-com bubble.
Unbelievable. Even before the 1929 crash, it was lower.
Right. It was only around 30.
So we are literally partying like it's 1999. But why? Why are the numbers so broken? Is it just hype?
It's largely a concentration issue. We call it the AI8.
The AI8.
Yeah. By the middle of last year, 2025, just 8 companies accounted for 22% of all S&P 500 earnings.
So the market is pricing in decades of future AI productivity, but it's doing it right now.
Precisely. Investors are betting that AI is going to boost productivity by 1.3% annually, forever, and they're paying for all of that today. We're front-loading all the gains.
And there's a risk here. I saw this in the notes. Something about work slop.
Work slop, yeah. It's a great term from some MIT research.
That sounds messy.
It is. It refers to AI output that's just good enough to pass a quick glance, but it requires so much human correction and fixing that it actually lowers productivity instead of raising it.
So if that productivity boom never shows up,
Then that 40x valuation collapses.
yeah.
Because you paid for perfection and you got, well, slop.
This brings us perfectly to Steve Eisman's take. Because he's not just a numbers guy, he's a themes guy. And he's seeing a very specific shape to this economy.
Yes, the K-shaped economy. This is key to understanding why the market is up, but everyone feels broke.
Okay, explain the K for us.
Well, imagine the letter K. The vertical line is the economy before, then it splits. The top arm goes up, that's the top 10%. The asset holders, the people owning those AI8 stocks, their net worth is exploding.
And the bottom arm.
The bottom arm goes down. That's the bottom 90%. They're getting crushed by what he calls severe inflation, things that actually matter. Healthcare, food, housing.
He used a phrase that really stuck with me. He said the market has become unmoored.
That's a fascinating observation. He's saying the S&P 500 isn't a proxy for the American economy anymore. I mean, look at it. The tech and info sectors now make up roughly 50% of the index if you include companies like Amazon and Netflix.
50%. That is a massive concentration.
It is. But look at the flip side. Consumer staples. The companies making the stuff we buy every single day. Toothpaste, cereal, soap. That sector used to be 10% of the S&P back in 2015.
And now?
Now it's shrunk to only 5%.
So the stock market basically doesn't reflect the daily life of an average person anymore.
Exactly. It reflects the clouds, not the street. And Eisman points out that index funds make this worse. 60% of money flows into index funds, which blindly buy the giants because they're giants. It's a self-reinforcing loop.
Which brings us to the plumbing of the economy. It's January, so it's earnings season. Banks always go first. What are the pipes telling us this week?
It's a mixed bag, but a very telling one. Goldman Sachs and Morgan Stanley both beat expectations.
Which makes sense. Investment banking is booming, M&A is back, the top of the K is making deals.
The deal makers are happy, exactly. But then look at the banks that serve, normal people. JP Morgan had a slight beat. Credit quality was stable, which is good.
But Wells Fargo missed.
Wells Fargo missed. Eisman says it's kind of their culture to miss now and then, but the market punished them. And Citi's beat, but their return on tangible common equity is still really low, around 7.5%.
Which is barely keeping up with inflation.
Barely. It's not great.
So here's what's weird to me. The results were fine, not disasters, but the bank stocks all fell. They corrected. Why?
Valuations. It all comes back to price. Goldman Sachs is trading at 3 times tangible book value. We haven't seen levels like that since before 2008.
So the market preached imperfection and good just wasn't good enough.
You got it. And then there's this weird situation with the yield curve. We've been hearing about the inverted curve for years, right? The recession signal.
Yeah, 2-year yield higher than the 10-year.
Well, it is disinverted. The 10-year is now at 4.17% and the 2-year is at 3.48%.
So the curve is normal again. That's a good thing, isn't it?
Paradoxically, no. Historically, the uninversion is the final signal before the recession hits. But in this specific moment, it actually helps bank margins.
Because they borrow short and lend long.
Right. They're enjoying the spread, even if the macro signal is flashing red.
Okay, let's pivot. We've talked about stocks being expensive in dollars. We've talked about the K-shape. But you mentioned something earlier about a monetary illusion. This is the part of the report that really blew my mind.
This is the aha moment. We measure our wealth in dollars, but the dollar is an elastic yardstick. It just keeps getting stretched.
Explain the elastic yardstick.
Imagine you measure a table today, it's 3 feet long. Tomorrow your ruler secretly shrinks. You measure again, and wow, the table's now 4 feet long. Did the table grow? No, your ruler shrank.
And the dollar is the shrinking ruler.
Exactly. So if you measure the S&P 500 in something finite, something that can't be printed, like gold, the picture flips upside down.
Walk us through the math.
Okay. In dollars, the S&P is near a record, 7,000, but priced in gold. The S&P 500 is currently trading at 1.5 ounces of gold.
1.5 ounces to buy the whole index. How does that compare to, say, the year 2000?
In 2000, At the dot-com peak, it took 5.5 ounces of gold to buy the S&P.
Wow. That's a massive difference.
It is. So in real money terms, the stock market is actually 72% below its 2000 peak. The gains you see in your 401k are mostly just the dollar losing value.
That puts the gold rally in perspective. I mean, gold hit, what, over $4,300 an ounce last year?
Yes. And the gold to M2 money supply ratio is at a record high. The market is sniffing out debt monetization.
And debt monetization is just the government printing money to pay its own bills.
Basically. With U.S. debt over $36 trillion, the math doesn't work with high interest rates. The market believes the only way out is for the Fed to print, which devalues the dollar and sends hard assets soaring.
This monetary illusion also explains the housing market, doesn't it? Because houses feel impossibly expensive.
They do. The S&P to Case-Shiller ratio is 21x. Stocks are expensive even compared to houses. But if you reprice a house in gold, it takes about 128 ounces of gold to buy a median home.
Is that high or low?
It's actually cheap. But that's a level we saw back in the 1980s. So if you hold gold, houses are on sale. If you hold dollars, they're a luxury good.
You know, Eisman had an interesting trade idea on housing. He likes the home builders, like Lunner and DHI.
He does. And it's a tactical trade. He calls it threading an elephant through a needle.
Why that metaphor?
Because it's a tight squeeze.
Yeah.
These are small cap stocks. He thinks Trump is pushing hard on affordability, ordering Fannie and Freddie to buy mortgage-backed securities to lower rates, which could give them a short-term pop.
That brings us to the political landscape. It feels pretty charged right now.
It is. And we're just reporting this neutrally, but the market reacts. There's a DOJ criminal investigation into Fed Chair Powell.
That's just unheard of.
It is. The market hates that. It sees it as political vindictiveness, and if the Fed loses independence, confidence in the dollar gets shaken.
And on the other side, there was that proposal to cap credit card rates at 10%.
Which the banks hated, obviously. It's a headline that creates a lot of volatility.
So we can't talk about all this without talking about the other elephant in the room, Bitcoin.
Right. Bitcoin is trading between, $87,000 and $97,000. It's acting as that call option on fiat failure, just like gold, but with more horsepower.
And the regulatory environment completely changed in 2026, didn't it?
That's the big shift. The passage of the Genius Act and the Clarity Act of 2025. These are huge.
What do those acts actually do?
They legitimize stablecoins and, crucially, allowed banks to custody crypto. It removed the career risk for institutional investors. So now a pension fund can hold Bitcoin. It's a recognized part of the financial plumbing now.
So putting this all together, expensive stocks and dollars, a debasing currency, a K-shaped economy. What's the strategy for the next decade? The report mentions a barbell strategy.
The expert consensus is that the old 60-40 portfolio, 60% stocks, 40% bonds, is dead. In a world of financial repression, bonds are guaranteed losers in real terms.
So what replaces it?
The barbell. Imagine a weight bar. Heavy weights on two opposite ends and nothing in the middle.
Okay. What's on the first side?
On one side, you want safety. There's 40-50% in hard assets. Gold and Bitcoin, things that cannot be printed. This protects you from that shrinking ruler.
And the other side?
The other side is growth. Another 40-50% in hyper-productive equities. Those AI companies with true moats. You want companies that can grow their cash flows faster than the dollar is losing value.
And the middle?
The middle is just liquidity, maybe 10% in T-bills, so you have dry powder to buy the dips.
There's one last warning in the data about something called the yield gap.
Yes. This is critical. Right now, stocks have an earnings yield of about 2.5%. That's the inverse of the PE ratio.
Okay.
But risk-free treasuries pay 4.17%.
So I can get over 4% guarantee from the government or take a massive risk on stocks for 2.5%.
Exactly. You are literally paying for the privilege of taking more risk.
Yeah.
That is a negative risk premium. It usually ends with a price correction in stocks to bring those yields back in line.
So what does this all mean? It feels like the market is screaming two contradictory things at the same time.
It is. It's screaming, technology is the future. That's the AI evaluation. And it's screaming, the dollar is broken. That's the gold and crypto price. Both can be true, but it makes for a very, very volatile ride.
So here's a final provocative thought for everyone listening. We cheered when the S&P hit 7,000. But if the S&P 500 is at an all-time high in dollars, but down 72% in gold, are you actually getting richer, or is your yardstick just getting smaller?
That is the question to meditate on.
This is a lot to digest, and if you want the full breakdown or you want to join a community discussing these exact kinds of value plays.
If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on Apple, Spotify Podcasts channel, Deep Value Investing, and luluvc.com.
好谢您，我是真弟弟说。
现在地产网地地当成为主机我新开行，是战地出的机，这地地方